Imagine a game. A game where the rules are constantly shifting. The playing field is a dizzying kaleidoscope of numbers, and your opponents, well, your opponents are often the most irrational, unpredictable force imaginable. Spod. And here's the kicker. Your greatest adversary isn't the market itself. It's not the algorithms, the hedge funds, or even that guy in the corner office with the ridiculously expensive suit. No, your greatest adversary is sitting right between your ears. For centuries, we've been told that investing is a science, a cold, hard, logical pursuit of value. That with enough data, enough analysis, enough rigorous calculation, we can tame the beast of the market. We are rational beings after all. Or are we? What if I told you that some of the most spectacular triumphs and the most catastrophic collapses in financial history were unborn from impeccable logic, but from a swirling vortex of fear, greed, ego, and the subtle, insidious biases that plague every single one of us? This isn't just a story about money, it's a story about human nature, laid bare on the grandest stage imaginable. Going to peel back the layers of history, dissect moments of collective madness, and expose the hidden psychological traps that have ensnared investors for generations. And by the end, you'll understand why the very wiring of your brain, designed for survival in the savannah, is now actively working against your financial well-being. And crucially, how to turn that weakness into an unexpected strength. Stay with us. The truth about investing and about yourself might just surprise you. To truly grasp the psychology of investing, we have to journey back to its origins. Before sophisticated algorithms and instantaneous data, before even the concept of a publicly traded company was fully formed, humanity was already engaging in a peculiar dance with risk and reward. The roots of speculation are as old as civilization itself. We're talking about ancient Rome, where merchants bet on the success of voyages. Medieval Europe, where promissory notes were traded like hot commodities. But it was in the Dutch Golden Age, in the 17th century, that something truly remarkable, and ultimately, profoundly unsettling, began to blossom. The Dutch Republic was a titan of trade, a crucible of innovation, and amidst this prosperity, a beautiful flower from the Ottoman Empire found its way into their wealthy homes. The tulip. Initially a rare novelty, certain varieties, particularly those with striking broken patterns caused by a virus, became status symbols. Demand grew. Prices started to climb. And then, something shifted. It wasn't just about owning a beautiful flower anymore. It was about the idea of the flower. By 1634, the price of tulip bulbs began an ascent that defied all logic. A single viceroy tulip bulb, at its peak, was worth more than a master craftsman's annual salary, or even an entire house. People mortgaged their homes, invested their life savings, all to acquire these coveted bulbs, not for their beauty, but for the expectation that someone else would pay even more. This wasn't rational economic behavior. It was a mass psychological phenomenon, a collective delusion fueled by optimism, envy, and the fear of missing out. What we now call the greater fool theory was playing out in spectacular fashion. I'll pay this exorbitant price because I know there's a greater fool who will pay even more. This speculative bubble swelled, driven by the purest, most primal human emotions. Everyone was getting rich, or so it seemed. Until, inevitably, the music stopped. In February 1637, the bubble burst, prices plummeted, fortunes evaporated, and the Dutch economy reeled. The psychological scar of Tulip Mania would linger for generations, a stark reminder that when emotion overrides reason, even the most beautiful things can become instruments of ruin. Slow. Fast forward almost 3 centuries. The world had changed dramatically, but human nature, it seems, had not. The 1920s in America were an era of unprecedented prosperity and technological advancement. The automobile, radio, and new manufacturing techniques fueled an economic boom, and with it, a burgeoning stock market. Investing, once the domain of the wealthy elite, became a national pastime. Ordinary citizens, encouraged by an eager press and seemingly endless growth, poured their savings into stocks. The narrative was intoxicating. Anyone could get rich. This wasn't just about corporate profits. It was about a new American dream. As prices soared, a dangerous cocktail of psychological biases began to brew. Confirmation bias meant investors only sought out news that supported their optimistic outlook. Anchoring meant they fixated on previous high prices, believing the market would always return to those levels. And herd mentality ensured that as more people jumped in, convinced by the success of their neighbors, the pressure to conform became irresistible. Too. The market, they believed, had entered a new era where old rules no longer applied. Margin buying, purchasing stocks with borrowed money, amplified the gains and the risks. The feeling of effortless wealth was addictive. But beneath the surface, cracks were forming. Economists and prescient observers warned of unsustainable valuations, but their voices were drowned out by the euphoric din. And then, in October 1929, the bubble burst with brutal force. Black Thursday, followed by Black Tuesday, saw the market shed billions in value. Fortunes vanished overnight. Panic gripped the nation. The psychological fallout was devastating. The crash didn't just wipe out wealth, it shattered confidence. The fear of loss, a far more powerful emotion than the joy of gain, took hold. This is loss aversion in its most potent form. The pain of losing something feels roughly twice as strong as the pleasure of gaining the equivalent amount. Investors scarred by the crash became deeply religious, contributing to the prolonged economic slump of the Great Depression. The dream of effortless wealth had morphed into a nightmare, fueled by the very same human emotions that had propelled its rise. We've learned so much since then, right? We have sophisticated economic models, high-speed trading, vast amounts of data at our fingertips. Surely, in the 21st century, we've purged the market of these irrational psychological demons. Think again. 2. Every few years, another new paradigm emerges. The dot-com bubble of the late 1990s saw internet companies with no profits, and often no clear business model, command astronomical valuations. Investors, caught up in the hype, ignored traditional metrics, convinced that this time it's different. It wasn't. The housing market collapse of 2008, fueled by subprime mortgages and a collective belief that house prices could only ever go up, plunged the world into a financial crisis. And more recently, we've witnessed meteoric rises and dramatic crashes in sectors like cryptocurrency, where emotional surges can often outweigh fundamental value. The tools are new, but the human brain operating them is fundamentally the same. We are still susceptible to the same ancient biases. Confirmation bias. We seek out information that confirms our existing beliefs, ignoring contradictory evidence. If you're bullish on a stock, you'll find every article praising it. Overconfidence. We overestimate our abilities and the accuracy of our predictions. Tine. I know better than the market is a dangerous internal monologue. Anchoring. We latch onto the first piece of information we receive, an initial price, a bold prediction, and filter subsequent information through that lens, even if it's irrelevant. Herd mentality. We feel an almost irresistible urge to follow the crowd, even when that crowd is charging towards a cliff. The fear of being left out of a rising market. FOMO is a powerful driver. Gambler's fallacy. Believing that past events influence future independent events. For example, this stock has gone down 3 days in a row. It has to go up tomorrow. Narrative fallacy. We crave stories and patterns, even when none exist. We construct compelling narratives around our investments, making them seem more rational than they are. These aren't weaknesses of character. They are inherent flaws in our cognitive architecture. Our brains are hardwired for quick decisions, for pattern recognition, for social cohesion. In the wild, these traits kept us alive. In the complex, abstract world of finance, they can lead us astray. The market preys on these vulnerabilities, amplifying emotions and rewarding irrationality in the short term, only to punish it severely in the long run. So, what do we do with this sobering knowledge? Are we doomed to repeat history, forever victims of our own psychology? Absolutely not. Understanding these biases is the first, crucial step towards mitigating their influence. It's about building a psychological defense system. Here are 3 critical takeaways to transform your investing psychology. 1. Know thyself. What makes you feel greedy? What makes you panic? Keep an investing journal. Note down not just your trades, but why you made them and how you felt. Did you buy purely on a tip? Did you sell in a panic? Recognizing these patterns in yourself is empowering. When you feel that surge of excitement about a hot tip or that gnawing fear when the market dips, pause. Ask yourself, is this a rational decision based on fundamentals, or is my monkey brain taking over? This pause, this moment of self-reflection, can be your most powerful tool. 2. Have a plan and stick to it. Your emotional firewall. One of the greatest defenses against psychological pitfalls is a well-defined investing plan. This isn't just about choosing stocks, it's about setting clear, measurable goals, defining your risk tolerance before the market gets wild, and establishing rules for buying and selling. For example, I will only invest X percentage of my portfolio in a single asset, or I will rebalance my portfolio every 6 months, regardless of market conditions. When the market inevitably gets volatile, your plan acts as an emotional firewall. It stops you from making impulsive, fear-driven decisions. Write it down. Review it regularly. And remind yourself that discipline, not brilliance, is the cornerstone of long-term success. 3. Embrace long-term discipline. The ultimate counter-strategy. The short-term market is a casino, driven by speculation and emotion. The long-term market, however, is a wealth creation engine, driven by innovation, productivity, and compounding returns. The vast majority of psychological biases we've discussed are amplified in the short term. By adopting a long-term mindset, thinking in years and decades, not days or weeks, you dramatically reduce the impact of daily noise and emotional swings. Ignore the pundits, ignore the frantic headlines, and focus on the underlying value and growth of your investments over time. Compounding interest, the eighth wonder of the world, works its magic slowly and silently, often rewarding the patient and disciplined far more than the frantic and reactive. The market is a mirror, reflecting not just the state of the economy, but the collective human psyche. It will continue to test your patience, your conviction, and your ability to override your most primal urges. The temptations of quick riches, the terror of losing everything, these forces will always be present. The challenge isn't to eliminate emotion from your investing, that's impossible. The challenge is to understand it, to respect its power, and to develop strategies to prevent it from derailing your financial journey. The choice is yours. Will you be another casualty of your own psychology, or will you master your mind and harness its power for genuine, lasting wealth? What are your biggest psychological struggles when it comes to money? Share your experiences in the comments below. If this video helped you understand yourself and the market a little better, please like and subscribe for more insights into the hidden forces that shape our world. Until next time, invest wisely and master your mind.